let's get started. B, we're on.
Yeah.
Hold on. Anytime. Just be careful, because if you go outside, I think the door locks at 6:30. So if you left something in your car, don't presume you're gonna get in, okay? So just be careful. I think John almost got locked out and would have spent the rest of the night out there. Oops. So, just a word to the wise. I think it's Saturday morning, just so you know that, just, the door should be, here's the good news, you have to come to class on time. Now that I say that, because I'll have access theoretically through a card, but short of me putting a rock down there, I'm not sure how we're gonna do this. But everyone has my cell number.
No, I didn't know. What is it?
973-670-7660. And just make sure you come to class with knowing the cell number. Because if you don't, and you get stuck outside, you're gonna be stuck outside. All right, because I can't come down every few minutes.
So the number ending in 1727, that's your office? Or?
1727 is my office number. But my cell number again is 973-670-7660. And just, you know, for some reason you hit traffic on Saturday, you shouldn't, but life is strange. And you get here at 8:35, let me know and I'll run downstairs.
You put your number on Blackboard, right?
I did, but just in case, because I need some extra steps for my Fitbit, all right? Let's see, 8,467, so getting close to the 10,000 mark. So if I go up and down here, guys, I'll be okay. All right, speaking of which, it's getting warm up here. So we have problem 2-1. Let's immerse ourselves in this, because that won't escape us. So we're looking not at the tax return preparer, we're looking at what our clients have to endure. And I said to you last class, I subscribed to this. I like these problems. Linda Gare is really immersed in practice, so I really think she brings a nice practical end to these things. Problem 2-1, Claudia is an independent contractor solving emergency problems for electrical utilities and travels extensively for her work. When she prepared her federal tax return last year, she deducted 100% of her expenses for meals and lodging while away from home in pursuit of her trade or business. But she kept no receipts and has very little in the way of records. If she was audited and some of all expenses are ultimately disallowed, could she be subject to a penalty under 6662? Assume that if deductions are allowed, the understatement will be substantial within the meaning of 6662D. Now keep in mind on the exam, I'm not going to ask substantive tax questions, okay? So, you know, this is not a class in income tax, but you guys recall that generally travel expenses can be deducted under Code Section 162, right? But we know meals are generally subject to a 50% limitation, right? That's Code Section 274N. And you're supposed to substantiate your travel expenses, right? Code Section 274D, right, requires substantiation. Right. So, bearing all those things in mind, does you have a risk of being subject? And we know the percentage, right? We said that accuracy-related penalties were generally what percent, John, do you recall? Right?
Isn't it like 0.5% per month?
0.5% per month is failure to pay on time.
5%.
5% is failure to file on time.
That's 20
And it's
75.
20% is the accuracy related penalty. So keep in mind, if your claim pays late, okay, pays, not files late, pays late, is 0.5% per month. Files late is 5% per month. Accuracy related penalty is 20%,
And fraud is 75.
and fraud is 75%, code section 6663. And there are variations. For example, if you have a transaction that lacks economic substance, what's the penalty? 40%. All right, it lacks economic substance. So there's a array of penalties. My opinion, if you don't mind me saying so, these you really, as a practitioner, if you're gonna call yourself a practitioner, I like everyone here to say they are practitioners, you should know this by heart, okay? Because clients, they wanna know, hey, what happens if I file late? What's the downside? And when you say 5% per month, that's gonna get their attention. But if they say, well, I don't have the money to pay, okay, and you say, well, at least file, the penalty for failing to pay is a lot less. It's 0.5%. But if they say, well, you know, what do I need to hire you? You can say, look, you don't need to hire me, but if you're inaccurate, you have the risk of a 20% penalty, maybe it's worth their while to hire you, right? So they have an accurate tax return. And if they're thinking about committing fraud, you may want to call attention 75% penalty. If they want to go into a tax shelter, right, that lacks economic substance, 40% penalty. So these are the kind of things that, and you know, notwithstanding the nature of the 2017 Tax Act, right? Supposedly one of the biggest tax acts in the last 10, 20 years. Did it change this at all, guys? The answer is no. And my suspicion, I can't tell you proof positive because the world changes rapidly, but this penalty structure has been in place for the last decade. I don't see anyone in Congress making strong overtures to say we have to revisit the penalty structure here. So it's worthwhile mentally for you to make the commitment to know this stuff cold. The exam itself is open book. But I'm just saying, when you want to converse with your clients, you should know this because your client's gonna harbor that expectation that you should know this by heart. All right, so, in problem A, I'll try to get people's names down. I was practicing this on the treadmill, and saying to myself, it's 3 syllables. Omari. Omari.
Yes.
See, I gotta stay more on the treadmill. Omari. I may have to do this phonetically on your part.
Okay.
All right. So Omari, is this going to be negligent or not? And then Nick, see if you agree.
Negligent of what?
This taxpayer right here, Claudia, subject to penalties or not?
Say negligent?
You say yes.
Yes.
Nick, do you say yes?
Yeah, I agree.
Yeah. Claudia is not our go-to taxpayer in terms of accuracy, right? She certainly has the risk because deducting 100% is over the top, right? She's doing it herself, and you know, it doesn't take too much. You can ask Alexa, you can ask Siri, right? And they're gonna tell you that you can't deduct 100% of these expenses, right? Right? Same facts as A, except that the CPA prepared Claudia's return, but never asked Claudia if she had any receipts or records. So Brian, Devontae, negligence or not?
Negligent.
You say negligent, Brian, agree?
Yeah, I agree.
Brian, Devontae, the fact that taxpayer used a CPA, do you think, she could get away with a good faith, reasonable cost? She had reasonable, hey, I relied on the CPA, code section 6664. What do you think?
I don't think so.
You don't think so,
No.
right, Devontae?
Probably not.
Yeah. Okay, even if you hire, people who give you bad advice and it's so self-evident, you can't put yourself under a rock and say, oh, it's not gonna be subject to a penalty. So even having a CPA is not gonna save you here. Okay. Safe X is A, except that Claudia has detailed receipts and records. So Trevor, Dixie, what do you think here? Negligent or not?
Negligence?
Dixie, you saying negligent?
Yeah.
Trevor, what do you say?
Yeah, I would say negligence.
Probably negligent, even if she has detailed receipts and records, and keep in mind, even if she weren't negligent, keep in mind,
She used up 100% now, she can't.
Well-
Practitioner wants to ask.
well, the point I was gonna raise is there is a substantial understatement. In other words, even if you're not negligent, okay, if you substantially understate your tax liability, it's called a no-fault penalty. So if you look, let's look at 66, 62, D1. If you have your code, everyone should bring their code with them. You ordered your code, you didn't get it yet?
No, I would the same way,
Alright,
hopefully it's the same as that.
hopefully you get it soon.
Okay,
You said D1?
Yeah, 66, 62, D1. Everyone have it? For purposes of this section, there's a substantial understatement of income tax for any taxable year if the amount of the understatement for the taxable year exceeds the greater of 10% of the tax required to be shown on the return for the taxable year. Alright, so what does this mean? It means that, if you have a substantial understatement, it's automatically considered subject to the accuracy related penalty. Because if you look at 6662B2, 6662B2, any substantial understatement of income tax, you're automatically subject to a penalty. Everyone see that? So one way or another, Cloudy's gonna enjoy the penalty. D, safe facts is C, except that CPA prepared Cloudy's return and never asked her receipts and records. The CPA simply accepted what she told him without any further inquiry. Okay? With this, Ming, B, does this get the claim, safeguard the claim at all? Ming, you say yes, no, B?
Not to protect.
No protection. I mean, again, most people are gonna assume that the 100% is over the top in terms of being negligent, right? And you're not gonna be able to have a reasonable cause here. If you go into D, E, same as D, except that the CPA told Cloudy that only 50% of her expenses for meals were deductible. They asked her if she had receipts for her expenses. She replied she had receipts and had actually spent twice the amount she told the CPA to deduct for the meals. So,
Just justify it.
say again?
She's just justifying it, saying it's no big deal because I had more than that anyway.
Alright, so what does she have a risk here of, V, because you had a smile?
Fraud.
Fraud. Right, you have a risk of a fraud penalty here.
Like, unless she was telling the truth, right?
What?
Unless she actually did, she's actually.
Well, she's, the way this is framed, she's lying.
Yeah.
Right, so, that's not a good thing. Probably it would be civil fraud, not criminal fraud. Question F, same as D, except that Claudia provided her CPA with complete receipts and records. So in this case, John, Mike, what do you guys say? Would this help?
I guess it could help her.
Yep.
Kind of put the blame on the CPA.
Yeah, I mean, here, finally, if she didn't do anything and she just said, here's my receipts, and she let the accountant prepare the return, there's a chance she could qualify under code section 6664 for good faith, as long as she did it in good faith. There's an example in the regulations which is somewhat similar to this. If you look at, when you get a chance, by the way, if you Google Treasury Regulation 6664-4B2, example 1. I'll repeat, 6664-4B2, example 1. Somewhat similar. And again, if you Google, like your code and regulations, this is an abridged version. It does not have all the regulations. That's why you got several emails from me, right, today, because I know you have an incomplete set of regulations. If you Google the regulations that the authors want you to read, the first thing that comes up will be from Cornell Law School, and it will have the complete regulatory site, okay? So it's very easy, and these regulations the authors cite us to, they're not very long, guys. So you might, by the end of the semester, have 20, 30 pages that you should seriously consider collecting. Just if it comes up in an exam or you want to review it, it's probably worth your while to just keep something printed out. I don't know how else to tell you to do it. All right? Question G. Same as A, except that in addition to her usual travel, Claudia likes to see her mother, who lives in Honolulu, a couple times a year, but the airfare costs are high. Claudia read an industry newsletter about an all-day conference on emergency readiness training for electrical utility industry scheduled in Honolulu on a Friday in November. Claudia decided to go flying to Honolulu on Thursday night, staying with her mother, spending all day on Friday at the conference, then visiting her mother on Saturday before flying after a nice brunch with her mother and her mother's friends on Sunday. Claudia deducted her airfare, air transportation, transportation costs, and the cost of meals on Friday and Saturday on her income tax return. If she is audited and some or all these expenses are ultimately disallowed, will she be subject to a penalty under 6662 for these deductions? And if so, to what extent? Is her case better or worse if she stayed at a hotel? Doesn't matter. Said it with her mother. So Gus, Andrew, do you guys have any thoughts here? Gus?
I think she would be negligent regardless if she stayed at a hotel.
She would be negligent unless she stayed at a hotel?
Even if she stayed at a hotel, she would.
And why do you say she's being negligent? And Andrew, do you agree?
It's hard to understand like what her true intent is.
Spent more than 50%.
And then,
Well, right, the regulations, right, if you guys recall from income tax, regulation 162-2B says, what is the primary purpose of the trip? If it's primarily business, deductible, right, in total. If it's primarily, if the primary purpose is personal, right, it's a 262 expense, it's non-deductible, right? What did I say during the class, if you guys may remember from income tax? it's a tough call, right? To know the primary purpose. Now, look, we can make it easier. If the conference was one day and she spent 2 weeks in Hawaii, you do not prorate. It would be the airfare would be non-deductible because the trip is primarily personal, right? Everyone agree? So, so that's an easy case. And if she deducted that, that would be negligent on her part, right? Everyone agree? That if she went for 2 weeks and she one day conference and she deducted her airfare, negligent. If she went to Hawaii for a 3-day conference and she was there 4 days total, 1 day in the sunshine, 3 days at the conference, it's a no-brainer, should be deductible, the airfare. The author is obviously saying this is a challenge, right? Like, it's not entirely clear what her intent is. So, right, because, you know, she's going the day before the conference, and given time zone changes, that's not entirely outrageous. And sometimes, if you stay on the weekend, it's cheaper to leave, right? The airfare is cheaper than had she left on Friday. So there may be a justification for her staying, aside from the fact she wants to see her mother. So for your notes, not to be purposely ambiguous, but you could argue that this is not, it shouldn't, potentially shouldn't be deductible, but I don't know if there would be a penalty imposed, okay? It's hard to say that this is necessarily negligent on her part for deducting this, right? And I don't know if her staying with her mother might suggest that it's more of a personal trip, so that makes it a little bit more problematic than had she stayed at a hotel.
I mean, couldn't she make the argument that she's doing
Saving money.
money?
I mean, lots of different things, and the fact you can make these different arguments, to me at least, suggests that probably the auditor would not impose a negligence penalty. Is it entirely clear? No, but. Question H, same facts as A, except Claudia attached a complete list of her expenses to her return. And the question, would this thing eliminate the penalty if she, back to problem A? She made disclosure, John, you're saying no.
A list is a list, a receipt is proof.
Unless there's what?
A list is just a list, a receipt is proof.
Can you remember, technically she should have used the form 8275, but she didn't, but that's okay. You don't need to use the form, but is this kind of disclosure gonna safeguard her from penalty imposition? What do you need? What's the standard?
Supporting documentation.
Say again, Ping?
Supporting documentation that
What do you need?
substantial.
No, you don't need substantial
Reasonable.
authority. Reasonable basis. Does she have a reasonable basis? Does she have a reasonable basis?
Yes, she provided a list of the documents.
But that doesn't give her a reasonable basis to take 100% deduction, right? The point the authors are trying to say is, you can't make disclosure and protect yourself from penalties unless you have a reasonable basis for taking that position. Hey, if it's subject to a 50% limitation, you can't get it, you're gonna be subject to a penalty here, right? Even if you make disclosure. Right, so for your notes, she has to endure a 66-62 penalty. Everyone got that? These are good questions. These are questions that your clients are gonna have. Problem 2-2 deals with the issue of what constitutes substantial authority, right? Because for most taxpayers, they don't wanna make disclosures, right? They feel like that's a target. So they're not gonna make disclosure. hopefully for most of your clients, they're not involved in tax shelters. So for most clients, the go-to standard is substantial authority. Right? So what constitutes a substantial authority? A position on Bill's federal income tax return supported by 2 private letter rulings, but a case from the U.S. District Court of the District of Montana has held to the contrary. Bill lives in San Diego. Is there substantial authority for his position? Let's pause for a moment. So he has 2 private letter rulings in his support, and there is a case to the contrary. Does he have substantial authority? So John, Viva, what do you say? Yes, no, maybe?
Court rulings are a higher rank of authority than private letter rulings.
Absolutely, court authority, but, does he have substantial authority or not? Viva?
They have, because he has the ruling, so.
And John, you say no?
I think so.
You don't think so? Okay, Peter, who's right?
I'm not sure.
But he's keenly aware of this court ruling, right?
I presume he's aware of the private letter rulings, he's aware of the private letter the court case. So, can he submit a return and avoid penalty imposition? Your answers, anyone wanna say? No one? What threshold do we say last class for substantial authority you have to be? Approximately. This is not a hard science. What?
75,
No, it's not 51 because that's more likely than not.
75?
75 is a should.
40?
40.
40%.
There's gotta be a 40% likelihood. So doesn't this mean that you can embrace both positions theoretically? That there's a substantial authority potentially for both? And when you look at this regulation, guys, private letter rulings are substantial authority, right? So therefore, he could take this position and avoid the penalty, right? If the situation were reversed, that is, Bill's position is supported by a district court case, where there are true private letter rulings to the contrary, is there substantial authority for his position? Suppose the case from Montana is 20 years old, but the private letter rulings were issued last year. So John, Viva, Peter, given what I just told you, how does that color your opinion, if at all? Is there substantial authority?
Yeah?
So yes, Viva?
Yes.
Peter?
I don't think so. It's the same.
Okay, I mean, on the face of it, there appears to be with a caveat or two that you would wanna, has anything in the law changed in the past 20 years to make that case, right? The Montana case is now 20 years old apparently. So, is there anything that has changed to make the Montana case obsolete, right? Because if it's obsolete, it's no longer substantial authority. And the private letter rulings may trump because they reflect the current state of the law. I can't answer that, but those are the kind of, don't just assume it's substantial authority because it's from one of the, what do we say, bona fide sources. It can be, because of changes in the law, deemed obsolete. Bill's return from 5 years ago was audited. Bill took the same position on, in that return as the position taken in this year's return. The revenue agent never commented on the position. Is there substantial authority for the position taken in this year's return? Okay, Mari, Nick, what do you think? Do you get the visual here? His return was audited a few half a decade ago, now he's taking the same position. Is that substantial authority?
I would guess yes.
Okay, next, what do you say?
I would say no because of the new tax law,
Say again, why no?
because of the new tax law taking effect.
What do you, I mean, I don't know what you mean, maybe there was no new tax law.
No, then I would say yes.
Well, let me ask you a question.
I think it would depend on the same factor before, that we would have to see if there was any rulings that had changed in between those 5 years. If that ruling was,
When you say ruling, all that happened, there was no real ruling. His return was audited, right?
There was no guidance as far as when it was audited,
Suppose I audit your return.
right?
I'm checking it out, and I say, okay, this passes muster. And 5 years later, you take the same position. Can you cite to the fact that your return was 5 years audited, say on a medical expense? And now you take the same expense, okay, but it's 5 years later. Can you avoid penalties if for some reason it's the wrong position? Suppose you take a pool as a deduction and now you move to another house 5 years later.
I guess not, because you should have addressed.
Can I say again?
I guess not, because you should have known.
Well, maybe,
Well, you wanna
look, let's
penalize,
face it,
right?
guys, when an auditor conducts an audit, he or she may not be thorough. And the issue that was not examined 5 years ago could be examined now. The fact that the auditor missed it the first round doesn't mean you have substantial authority just because the auditor may have missed it the first go around, right? So you don't have substantial authority in this context. Just think about it, it's a practical matter. That every time an auditor does a slipshod job, doesn't now give license or carte blanche to the taxpayer to keep taking the same fallacious position. Right, so that would not constitute substantial authority. Question C, same in facts as B, except the revenue agent issued this time a written report at completion of the audit. The report specifically approved of the position. Is there substantial authority for the position taken in this year's return? And your answer, Brian, Devontae,
I wanna say yes.
okay?
I
Right?
agree.
Okay, and there's authority for this, if you wanna, this one is in our rate book, if you wanna take a look. 66, regulation 6662-4, D3, 4 little I, A. Okay, well, it's page 1825 in this version of it. Right, you don't have it. Right, so I'll repeat. Regulation 6662-4D3, 4 little I, capital letter A, entitled Special Rules Written Determinations. Says, there is substantial authority for the tax treatment of an item by the taxpayer. The treatment is supported by the conclusion of a ruling or determination letter issued to the taxpayer by the conclusion of a technical advice memorandum in which the taxpayer is named by an affirmative statement in a revenue agent's report. So, this one, look, an IRS auditor looked at that particular issue, said it was kosher, and you're just embracing the same position. Should you be penalized, guys? Think about that.
No.
In that case, they did say this was kosher. Question D. Same facts as C above, except that last year, the IRS issued a revenue ruling taking a contrary position. Do you have substantial authority any longer? And I heard someone just whisper, "Ping, was that you saying no?"
Well, what if Bill didn't find out?
Say again?
What if Bill didn't know about the,
Does ignorance help you?
no,
Because then you incentivize taxpayers to be ignorant.
but then, yeah, but then, I mean,
It doesn't, and if you look, let me give you another citation because you want one, right? This is a long one, everyone bracing themselves. 6662-4 D3, 4 little I, capital letter A, 2 V. I'll repeat, 6662-4 D3, 4 little I's, that's exactly where we were before. Now we're gonna continue the site, A, 2 V, which, if you look, under 4 little I A, it says the preceding sentence shall not apply, however, if, and 5 little I says the issuance of a revenue ruling, revenue procedure, or other statement published by the Internal Revenue Bulletin. All right? So, the fact that you were audited and a report was written is not written in stone. Question 8. Same facts as C above, except a recent U.S. District Court decision from the Southern District of New York held to the contrary. Okay. Trevor, Dixie, what do you think? If you have a district court from somewhere else, do you still have substantial authority?
I wanna say no.
You lost substantial authority. Dixie? Just, look, let me just tell you that generally, if you have a written report, that's pretty good, right? Everyone agree that someone, the IRS agent has given you a written report, and you continue that, you know, to use that. And if the IRS is a national organization, everyone agree? It issues in the prior one, a revenue ruling that obliterates your position. We already decided that, agreed? But a district court, right, which is not part of your district, that could be right or wrong, right? And what if you look back at this ruling, it says, when I say the ruling, I'm at Treasury Regulation 6662-4D3, 4 little I. That's dealing with substantial authority, where there's a written report. It says it only doesn't apply if it was a decision of the U.S. Supreme Court, right? In other words, that written report doesn't apply. I'm looking at A2, it says a notice to taxpayer to whom it was written was issued, the enactment of legislation or ratification of a tax treaty, the decision of the U.S. Supreme Court, the issuance of temporary or final regulations, or the issuance of a revenue ruling, revenue procedure, or other statement published by the Internal Revenue Bulletin. So in other words, these are exceptions. The district court opinion does not fall within the scope of these exceptions, so you would still have substantial authority. So your answer in question A, substantial authority still applies, and therefore the penalty would not apply. There would be no penalty. Question F. The same facts as C above, except the tax court recently held to the contrary. And that changed the outcome because the tax court is a national court as opposed to a district court. And at least the way I read the regulation, does not it only says the particular ruling would be potentially thwarted by a decision of the Supreme Court. So that being the case, the decision by the tax court should be treated just like the district court. It's not exempted, so therefore there should still be substantial authority. So your question to E and F, questions E and F, is substantial authority remains intact. Bill's position as returning contrary to the express language of the statute, okay? But a statement in the reports of both the House Ways and Means and Senate Finance Committee indicates that Congress expected the Treasury Department to issue regulations which are consistent with Bill's position. Is there substantial authority? So, in this case, Ming, V, what do you think? How about this committee report?
I don't think the committee report holds.
You say no, Ming? Look at Regulation 62-4, okay? D, 3 little I, it's entitled Types of Authority. Everyone agree? Types of Authority, everyone see that? Under 3 little I?
Oh, it does have congressional intent as reflected in committee reports.
So committee reports work. So this would be substantial authority. Peter, I'm just gonna say, can you just try the thermostat? I don't know about you
It's
guys.
just low, it's gonna be, I took off my jacket, it doesn't go in low.
Alright,
I took off
I have
my-
to talk to her.
Cause I was,
It's still warm in here. Devontae, you may melt, okay?
I'm sorry, what was the, code on that one?
Let's try that. Yeah, it's just noisy out there.
Yes.
1 second. I was pushing it hard. If you press it gently, it actually, the magnet works. All right, see if that cools us down a bit.
Can you repeat the,
Yeah, Regulation 62-4, D, 3 little I. Includes committee reports. Question H, Bill's position is contrary to the express language of the regulation, but is supported by a decision of the tax court that was issued before the regulation was promulgated. Is there substantial authority for Bill's position? So Gus, Mike, what do you guys say? Hey, Gus, can you take this position?
I don't think there's no substantial authority.
So here you think there's no substantial authority? Mike, what do you say? No substantial authority. Right. Anytime you take a position directly contrary to the regulations, guys, you're not gonna have substantial authority, okay? And wait, if you think that you have a reasonable basis for challenging the regulations, you have to make disclosure, right? So regulatory authority is pretty powerful. If you guys remember from income tax, there's a US Supreme Court case from 2012, Mayo Foundation, M-A-Y-O, Mayo Foundation, for the proposition that deference should be given to treasury regulations, that in general, they should be upheld unless they're arbitrary and capricious, which is pretty hard to prove, right, that regulations are arbitrary and capricious. So, you can't even rely on good faith, okay? You can't try to avoid the imposition of penalties here, even if you think in good faith that the regulation is invalid. My authority for that is regulation 6664-4C, 3 little I. I'll repeat, 6664-4C, 3 little I. Question AI. So, question H, no good. Potential accuracy-related penalty. Question I. Bill's position is supported by a statement in the most authoritative treatise on the subject, but is contrary to a revenue ruling. Is there substantial authority for Bill's position? So in this case, John, Hank, what do you think?
I would say no.
No authority. Ping, what do you say?
No.
Okay. The author's point in saying this, that treatises, right, even if they're Bicker and Eustace, they're very famous treatises, doesn't matter. They're not considered authority. Does it matter whether the treatise provides a well-reasoned argument in support of the statement that it makes? It makes no difference. Bill's position has been rejected by 3 circuit courts of appeal, but the Court of Appeals of the Ninth Circuit has ruled the other way, supporting Bill's position. Is there substantial authority? So Andrew, Peter, what do you think? I'm sorry, Andrew?
I said,
You say no.
I think the rulings of the Supreme Court are the others.
But that, don't confuse things. The Supreme Court was with respect to if you had a written ruling based on an audit. This is just saying there's 2 different court opinions. Circuits are going in different directions. Andrew?
I'm really sure on this one.
Okay? And in this case, Viva, what do you say, John?
They have authority, so it's probably more than 40% chance.
So you're saying there is substantial authority?
Yeah.
Viva?
Yes.
Yeah, I mean, this is the traditional split in the circuits. You're allowed, even though there's 3 in one and 1 in the other. I mean, the fact that an appeals court is agreeing with your position may ultimately, in the Supreme Court, if and when writ of certiorari is granted, may prevail. So, and you don't have to prevail all the time. You have to only prevail 40% of the time.
What if there was more than 3 circuit courts?
I mean, as long as you have a circuit court of appeals, I think you have a substantial authority.
Okay.
All right. The only problem with trying to get fresh air in here is we have to deal with. So we'll see if I can survive. Question K. Same facts as J above, except that the position with respect to is with respect to a quote-unquote defined tax shelter item. The bill's position is not adequately disclosed on the return. Is he subject to penalty? Can he avoid the penalty by disclosing the position? So in this case, Amari, Nick, what do you say?
I would say yes, because he didn't adequately disclose it.
Say yes, he's subject to a penalty.
Yeah.
Omari, what do you say?
I would say yes to, and also,
What's the threshold,
No.
yes? What's the level of certainty, yes, at?
More likely
for
than
substantial
not.
authority.
51.
No.
It's more likely than not substantial, it's a tax shelter, right?
Oh, okay.
Be careful, for exam purposes, with clients' purposes, you cannot state the wrong standard, right? You state the wrong standard, that's not good. So you gotta meet the more likely than not standard under regulation 6662-4G1, I'll repeat. 6662-4G1. And disclosure is no defense when it comes to tax shelters. So even if you disclose it, it doesn't constitute a defense. That's regulation 6662-4G1, 3i.
So you can't avoid a penalty in that situation.
Nope, so you're gonna be subject to a penalty here. There is no substantial authority. It says, question now, if we included any of the parts A through K above, the position was not supported by substantial authority, did the position nevertheless have a reasonable basis? So did there anything that we concluded the taxpayer fell short of the mark? Could we have said they had a reasonable basis and therefore they could make disclosure under Form 8275 and avoid the penalty? And just to remind you, in D, H, and I, we drew the conclusion that there is no substantial authority, but there is probably a reasonable basis. Right, so the author's point about D, H, and I is taxpayer possibly could, as long as the taxpayer was willing to make was willing to make disclosure. All right, beginning on page 57, everyone, we just took a look at penalties and penalties taxpayers were subject to. The thrust of the authors pertain to code section 6662. But again, you guys know that there's several other penalties for late payment, late filing, accuracy-related fraud. Those are 4 different penalties that taxpayers are potentially subject to. There's others, but those are 4 biggies. Practitioner, go ahead.
What's the E regulation? E, I mean the question E, the regulation.
Question E, the one that,
43, 49.
okay, let me say that one more time. Regulation 6662-4D3, 4 little I, capital letter A, 2, 3 little i's.
So this is substantial authority, no penalty.
I'm
This
not
answer,
sure.
the answer is
Yes.
no penalty, right?
Yeah, but
Substantial authority,
Right, there is no penalty.
okay.
So, dealing with tax practitioners, okay? Just bear in mind, now we're talking about tax return preparers, not taxpayers, what kind of penalties do professionals, and we're talking about lawyers and CPAs and anyone who prepares tax returns. It's kind of interesting, if you looked at footnote 19, says there's some empirical evidence that non-compliance is greater with returns prepared by return preparers than returns prepared by taxpayers themselves. That's scary, okay? But that's true, okay? There's a lot of academic studies out there. Some are more accurate than others, but if it's true, that's a pretty sad statistic. Right. So you guys can read this. What about who is a tax return preparer? And by the way, what you should do, again, I've emphasized this before. I sent you, these are all, I mean, there's other sites too, but I printed out for myself just to mark it up. Regulation 6694-1, right? I sent this to you, pretty sure. 6694-2. And Regulation 7701-15. Regulation 7701-15. Now, 7701-15 defines who is a tax return preparer. This is important because, no secret here, the 6694 penalty, which if you want to open up for a second, let's just take a look at the 6694 penalty. $66.94 says if a tax return preparer prepares any return for claim for refund with respect to which any part of the understatement of liability is due to a position described in paragraph 2, and knew or reasonably should have known of the position, such tax return preparer shall pay a penalty with respect to each such return for claim in amount or claim in an amount equal to the greater of 1,000 or 50% of the income derived or to be derived by the tax return preparer with respect to the return of claim. And the unreasonable position, except as otherwise provided in this paragraph, the position is described in this paragraph unless there is or was substantial authority. So once again, you need substantial authority. You're supposed to, same standard as taxpayers. If the position is disclosed, there has to be, as you'll see in capital letter B, a reasonable basis, and when it pertains to a tax shelter, says that it's got to be more likely than not. And if you look at 6694, A3, there is a reasonable cause standard, exception, reasonable cause exception. If it's beyond negligent and it's due to willful or reckless conduct, the penalty is raised. That's in 6694B. It's the greater of $5,000 or 75%. You want to see that? So there's a greater penalty. Who's subject to this penalty? We said before, tax return preparers. Now, tax return preparers is defined under 7701A36 is the statutory definition, 770136. But the regulations add elaboration. And they point out that who is a tax return preparer? They come in two flavors. Signing tax return preparer and non-signing. Signing tax return preparer is an individual tax return preparer who has primary responsibility. Non-signing, who prepares all or a substantial portion of the return for claim for refund within the meaning of paragraph B3 of this section. With respect to events that have occurred, I've underlined that in red, with respect to events that have occurred, not to events that will occur, that have occurred at the time the advice is rendered. And we'll see what the implications of that momentarily. So, what problems 2-3 through 2-7 get at is what kind of penalties are people like us who prepare tax returns, what's our potential exposure? Like one, do we have exposure? That's the preliminary question. Do we have exposure? And if so, how do you compute the penalty? I always say to my students that the bigger question is, if you get hit with one of these penalties, there's a bigger risk. By definition, if you get hit with one of these penalties, your case must be referred to the Office of Professional Responsibility. That doesn't mean that you have a Circular 230 violation. But it does mean that they may look, and if you keep getting 6694 penalties, may suggest that you are a practitioner in need of some reprimand. All right. Has anyone? I got to be careful. Has anyone here ever had a 6694 penalty? You may not want to tell us, but you might say a friend of yours had it, and then tell us the situation. I will tell you this. I try not. I don't know. And yesteryear, I never had to worry about things being taped because no one had iPhones and whatnot. So I always could say this and feel like it would just go into the ether. But now, with everything being videotaped, I get a little bit more nervous. But why not air all the dirty laundry? So I've told you about my quick war story. So I'll give you one more tonight. I have one probably every night or 2 or 3 I could give you, but I don't want to. But I had a situation, and if I told you a particular story, then don't just say you said that one, don't say it again. So I had a situation where a gentleman unfortunately passed away, and he was worth big money, like 15 million, I don't want to exaggerate. And the accounting firm was handling the 706, that's the estate tax return. And the accounting firm, it wanted me and my colleague to look at one aspect of the return with respect to a closely held business and minority discount. So they said, look, we want you to look at how we reported this closely held business and if this made sense with respect to the discounts and all that. Fine, we can handle that. And this is where it gets dangerous. Could you just take a glance at the rest of the return? And I learned a lesson when I should have, they're nice people, but I should have said no. The scope of our engagement is just to look at this one facet and that's it. Because once someone says, can you take a look at the rest of the return and just get, okay, all bets are off. And we did what we needed to, and we took a look at the return, and it's hard for me to describe for you guys, but there's a line on the return where you had the gross estate, and then it says credit for prior taxes paid. And it was a number that you, on the Form 706, whatever the, it's hard to articulate this, the estate tax exemption was during this year, during the year in question. Like, do you know how sometimes returns have an automatic number that get filled in? Like, sometimes the computer will fill in the number because the code has a particular threshold or particular number. Anyway, when that number appeared, it looked to both my colleague and me to be that number that was just computer generated. So when we glanced at it, there was no problem. And it showed that the taxpayer should get an equivalent of, I don't remember with specificity, but something like a $450,000 credit because of the estate tax exemption. Long story short, submitted the return, and like 8-9 months later, get contacted by the IRS. And they say, well, you reported that you should get a credit of that $400,000 or $500,000, whatever that number is. And by the way, the taxpayer never paid that. You made a statement. In other words, they interpreted that. In other words, unbeknownst to my colleague and me, and to the accounting firm, that was not a computer-generated number. That was a number that was filled in by someone at the accounting firm, but all the people reviewing it thought the computer had generated it. And it was just wrong. And it looked like we were trying to get away with saving a $500,000, that if this weren't reviewed, we would have saved the client $400,000 to $500,000 just because of our mistake. Well, the IRS picked it up and there was no excuse. So I was worried because the accounting firm was gonna potentially be subject to a 6694 penalty. The client wasn't happy because the client was smart, because as soon as we told the client, many clients would say, are you sure? And would take months to resolve this because they have to now cut a check. And I'm sure the check was nearly $500,000. And a lot of clients would have balked at that and said, this client was really smart and said, okay, we get it, we'll pay it, and move on. But still, I thought the accountant might get hit with the 6694 penalty, and I might get hit with the penalty. Long story short, the accountant wrote a very mea culpa letter saying, I am so embarrassed, I am so sorry, nothing like this has ever happened to me before. And the IRS did not impose a 6694 penalty. And I had a few sleepless nights myself about that and sort of my responsibilities, but it's one of those things that when someone says, can you just take a glance at this? And I'll give you a story. I mean, that story still resonates because an attorney about a week ago, actually I was just leaving for Japan, and I get this email, can I help this attorney? He's from New York, he would like to come to my offices to just have someone sign New Jersey documents, signed. Okay, I email back right before I get on the plane, no problem, okay? And he says, good, mid-January, I'll come to your office, I so appreciate your help, okay? And he said, can I pay you? No, just use my office, I'm happy to help out. I get an email from him last week. Dear Mr. Solid, thank you so much for letting me use your offices. Attached are the documents. Would you mind taking a quick look to see procedurally if I have the right documents in place for my clients? I'm thinking to myself, are you kidding me? Like, I don't know who these clients are. I don't really know what he's trying to achieve. And if there's something wrong with these documents, who are the clients? He will be sued, right? But I know my brother and attorney, when they sue people and they see that somehow I was reviewing the procedural, who's gonna be sued? I'm gonna be sued too. I thought that was so outrageous, and I still think of the case I'm telling you where this accountant had said, could I just take a quick glance at the rest of the return? Just be careful when people ask you, particularly in emails, can you take a look, quick look? That quick look, by the way, means don't bill it, but look at it. Let me translate that for you, all right? And even if they said they'll pay you, do not risk billing 1 hour and saying, gee, I'm gonna be able to get my billables up this month, I'm gonna be able to bill an hour. That 1 hour will never compensate you for all the anguish that, because you know, if you bill 1 hour, you're never gonna look at everything. And if there's something wrong with it, you will be sued, okay? So just, there's a big downside by being just a little involved, okay? So I've learned in life, not that case from 15 years ago has taught me not to be a little involved, okay? Either go in full throttle or you don't go in at all, all right, guys? So just remember that. Those are dangerous responses. And I still think about that potential 6694 penalty. All right, page 62. Cindy CPA provides return preparation guidance, but rarely actually prepares return. Bill teaches kindergarten and knows how to handle most of the items on his return, but he's received a Schedule K1 from an S corporation controlled by his sister. S corporations are partnerships or pass-through entities. Although they must file or prepare and file returns, their income deductions and credits are passed through to and reflected on the returns of their shareholders or partners. This information is provided to shareholders and partners in detail in Schedule K1, which provide them with information on their eligible share. This is right on the K1 of non-separately reported items or losses, and all items that must be taken into account separately. The Schedule K1 shows his share of S Corporation non-separately stated income to be about $9,600, or as $9,600, as well as small amounts of separately stated credits, a capital gain of $570, Section 179 expense of $800. He sends Cindy the Schedule K1 as well as other information about his investments, asks her how he should handle the Schedule K1 data. She sends him a short letter explaining which forms he needs to file and where the items on the Schedule K1 should be reported on those forms. But she incorrectly advises him that he doesn't have to report the income because it is less than his basis in the stock. He allows her, he follows her instructions and files the return. So he's saying, with respect to the S Corporation income, you don't have to report it. Why? Because he's saying it's a return to basis. And that's not true, right? S Corporation income has to be reported. Distributions, not income, distributions, subsequent distributions, right, don't constitute, unless they're in excess of basis, they don't constitute income, right? So she's just dead wrong, right? Is she a tax return preparer? Is she a tax return preparer? So I don't recall where I left off. So Brian, Devontae, what do you guys say? Is she gonna be considered a tax return preparer?
Cindy, right?
Cindy.
But it says she's a CPA, yeah, she,
The fact she's a CPA does not make her a tax return preparer. Right, Devontae, right, Brian? But is she in this context?
Yeah.
I think so.
she gave her guidance.
She
She gave the guidance.
Right, but did she sign the return?
Just non-signed.
No.
No,
Okay, so
not yet.
she's not a signing, does she constitute a non-signing? And how do we know if she is or isn't? What's the threshold to know she's a non-signing tax return preparer? What's the, now again, guys, I'm just, for class, you may want to Xerox up some of the regulations or print them out and mark them up.
5%, less than 5%.
That's an exception. That's a different rule. Non-signing repairer who prepares all or a substantial portion. Is this a substantial portion?
For example, suppose give advice to the taxpayer when they want to application.
Fine.
B3.
Substantial portion is defined in 7701-15, right? B3, right? B3 is entitled substantial proportion. Only person who prepares all or substantial portion of a return or claim for refund shall be considered to be a tax return preparer of the return or claim for refund. A person who renders tax advice in a position that is directly relevant to the determination of the existence, characterization, or amounts of an entry that on a return or claim for refund will be regarded as having prepared that entry. And it goes on from there. And then 2 little I says, for purposes of applying this rule, okay, it says it has to be, it will not be considered if it's less than 10,000 or less than 400,000, and also less than 20% of the gross income is shown on the return. You guys can look at this, but in this context, is this a substantial portion?
No.
No.
Remember, Bill is a kindergarten teacher. How much does the average kindergarten teacher get paid in Florida, Alabama?
30,000, 40,000?
This is probably pretty substantial from Bill's perspective, right? I mean, we don't know that for sure, but the de minimis exception that I just spelled out to, where it's less than $10,000, it's not, right? It does not meet the definition here of the de minimis exception. By the way, this book, our textbook, inspired me to read this book on page 20, footnote 25. You may have heard about this book. All I really needed to know, I learned in kindergarten. It's kind of a cute title. I read the book. It wasn't a great book, so you don't have to pick the book. Okay, whatever needed to be said is said right here in footnote 25, so I'll save you. All right, so for your notes, problem A, probably she would be considered a tax return preparer, and since the income here exceeds $10,000, can't fit within the scope of that de minimis exception. By way of contrast, if you look at question B, with your answer to change that the capital gain were 370 instead of 570, and here probably could qualify for the $10,000 exception. And just, if you take a look here, there's several examples. When I printed out, there's example 1, 2, and 3. Example 2 fits the bill, okay? Example 2 here. Example 2 is found in Regulation 7701-15, B3, 4 little I, example 2. So there's more examples on the following pages. So let me repeat that. That's 7701-15, B3, 4 little i's, example 2. Question C, will your answer to A above be the same if Cindy provided instructions with respect to filling out the remainder of the entire return? How would this, Mike, John, what do you guys say? What happens if she provided instructions as to the filling out of the entire return? What should happen in this context? She gives instructions about filling out the entire return. Well, let's look at 6695. What's section 6695? Yeah, it's not in your book, but I was looking at it beforehand. What happens if you prepare an entire return? You're supposed to sign the return, right? Or else you have a penalty, right? So she runs the risk of enduring a 6695 penalty, right? Excuse me, you can't give instructions about how to complete a whole return, right? And not sign it. That's a big no-no. So she has a risk of a 6694 penalty and a 6695 penalty. How would your answer be different if Bill were a successful ophthalmologist? How would that change it?
She will be penalized.
Say again?
So, the Cindy will be penalized for that 10,000 because the
Well,
income will be high.
She might exceed the 10,000, but there's two tests, right? It's the lesser 10,000, or you'll see if you print it out. She could, in this case, if he's an ophthalmologist and he's making 400,000, this is probably not a substantial part of his return. And remember, you're only a non-signing return preparer if you help prepare a substantial portion of the return. So it probably fits in the scope of that second safe harbor. Okay, it's less than 10,000, or there's another one. Yeah, less than 400,000, and also less than 20% of the gross income. So probably would qualify as a non-signing, so she wouldn't be subject to a penalty here. You guys good? So again, the authors are just trying to sensitize us. When is a 6694 penalty applicable? But we have to know who is a tax return preparer and who is not. Problem 2-4. Kim is a tax lawyer. She has prepared the return in Schedule K1 for a 23 partner partnership. Bob's percentage is a mere 1%, is the smallest of all the partners' interest. The non-separately stated taxable income figure of the partnership is $200,000, which reflects large deductions for repairs to a building owned by the partnership and depreciation. Bob's pro rata share of these deductions, if separately stated, would have been more than $51,000, but his non-separately stated taxable income share is only $2,000. Kim is vaguely aware that Bob was at some point a quote-unquote starving artist. Is Kim a tax return preparer with respect to Bob's income tax return? And what about with respect to the other partners? So she's a tax attorney. She's preparing return in Schedule K1s. I just wanna cause your attention. This is again under regulation 6601-15. Okay, 7701-15. And we have B3, three little i's. B3, three little i's. And it says, a tax return preparer with respect to one return is not considered to be a tax return preparer of another return. So tax return preparer for partnership is not considered the tax return preparer for the partners, right? Merely because an entry or entries reported on the first return may affect an entry reported on another return, unless the entry or entries reported on the first return are directly reflected on the other return, constitute a substantial portion of the other return. For example, the sole preparer of a partnership return of income or a small business corporation income is considered a tax return preparer of a partner's or a shareholder's return if the entity or entities on the partnership or small business corporation return reportable on the partner's or shareholder's return constitute a substantial portion of the partner's or shareholder's income. So, in other words, if you prepare a Form 1065, which is a partnership tax return, or a Form 1120S, which is an S corporation return, and the K-1s that are generated are substantial in nature, that substantial relative to the taxpayers who are members or shareholders, then you could be considered a tax return preparer as to those returns, right? So, is Kim considered a tax return preparer? By the way, the citation I just gave you is right here in the book, at the very bottom of the problem, but. And it really would depend on whether or not the K-1s reflect income substantial relative to each of those partners, right? So not to make your notes ambiguous, go ahead, John.
So if you prepare like a partnership return that has like, let's say 50 partners, and like one partner, the only income he has is from that partnership, so you could be responsible for whatever they report on their return?
Well, if you're inaccurate, you could be held to a 6694 penalty, right?
Yeah.
Because they're reporting it, and if it's deeply flawed, shouldn't you be held accountable for it?
Alright, for your own errors, not if they
Right.
did, if they did
Not the
something.
rest.
Okay.
Just as to that error. Because if not, remember, a partnership is never gonna pay any tax. So you can't give carte blanche, because then you sort of incentivize the person to make errors because he or she is immune from any penalties. All right, so potential penalty exposure. Problem 2-5. Harper, a member of the Model State Bar, spent 100 billable hours during year one advising client Claude, how to trade his appreciated apartment building for 2 rental properties in the Section 1031 like-kind exchange, and then reviewed documentation for transaction to be sure to comply with 1031 requirements. By the way, I'll say parenthetically, in the last Tax Act, in the 2017 Act, Congress greatly narrowed the application of Code Section 1031. It used to broadly apply to any like-kind exchange. And I know many are gonna fall off your chair when I tell you 1031 was greatly narrowed, but narrowed to only permit the real estate industry to have like-kind exchanges. So But, so the problem still works because this pertains to real estate, I'm just, the transaction was completed in September of year one. In February of year two, Claude called Harper and asked for a detailed written explanation of the tax consequences of the transaction to provide to a CPA who was preparing Claude's year one tax return. Harper spent all the day the following Saturday, 9 billable hours, drafting the requested document. The Section 1031 exchange itself did not result in any gross income to be included on Claude's income tax return, although the gain realized in the sale exceeded Claude's total includable gross income of the year. So I'm just gonna pause for a second. Let's just say the real estate Claude owned had a basis of 100,000 and was worth $1 million. So there's a potential gain there of 900,000, right? But let's just suppose Claude for the year only made he made a nice 600,000, right? But by engaging in a 1031 exchange, he was able to negate Code Section 1001 tax on 900,000, but still had to report his $600,000 of salary income. However, the document prepared by Harper detailed how the transaction qualified for like-kind exchange treatment and provided the basis and depreciation computations that Claude needed to use for reporting the rental income and expenses from the properties received in the exchange. Is Harper a tax return preparer with respect to Claude year one's tax return? Let me keep my mouth shut. Take a 1 minute look at this. See what you think. Okay, show of hands. Who says Harper is a tax return preparer? One person. Who says not? Can't fence it. So you gotta, can I get it? I know it's late. No, everyone had a long day. Show of hands. Who says Harper is tax return preparer? So if you think he is, raise your hands. Is not, raise your hands. Most people think he is. D, you said yes. Why?
Because it's a substantial portion of Claude's income. I mean, what Harper did was substantial.
But
with respect-
keep in mind, Harper did a lot of work. Everyone agree? But remember, under the definition, the work has to be with respect to events that have occurred, past tense at the time the advice is rendered. The events that have occurred. So planning, what do we say? People who plan a transaction are not considered tax return preparers. Everyone agree? That if you spend 1,000 hours devising a transaction and you step away, are you a tax return preparer? And the answer is no, right? If you spend 1,000 hours or 10,000 hours devising a tax shelter, you are not, because you're only a tax return preparer with respect to events that have occurred at the time the advice is rendered. Okay, deep breath. Okay, where am I reading from? This is just under the regulation 7701-15 B2. B2.
And what is a C? That mechanical or clerical assistance, a person who furnish to taxpayer or other tax return prepare sufficient information and advice so that completion of the return or claim for the refund is, that is not considered.
Well, where are you
On the
looking?
same page, on the same one.
But let me just pause and then maybe I'll answer your question, maybe I won't. So, if you render planning advice, you're not a tax return preparer. That same sentence goes on to say, however, it says, in determining whether an individual is a non-signing tax return preparer, time spent on advice that is given after events have occurred that represents less than 5% of the aggregate time spent, time incurred by such individual with respect to the positions to under statement shall not be taken into account. So, if you represent or conduct planning advice, that is not considered tax return preparation, right? Planning advice is not tax return preparation. But if subsequently, after the event has occurred, after the whatever plan you put in place has occurred, and now you render more advice, if it's less than 5% of the time, overall time, then that's okay, you're not gonna be considered preparing the tax return. But here, how much time was spent, guys? 9 hours, right? And what's 9 over 109? Is that more than 5%? And the answer is yes, right? So, in this case, the taxpayer, or here, would be a tax return preparer. Harper would be, because he doesn't meet the safe harbor. So here, because if he didn't render, by the way, if he didn't render this extra 9 hours of work, would not be considered a tax return preparer. I will point out, remember the penalties based on a dollar amount or 50% of the greater of the dollar amount or 50% of the fee for services rendered, right? I will, just for your notes, the fee is not 50% of 109 hours. The penalty would be imposed on 50% of the 9 hours. Like if his billable rate was $100 per hour, the penalty would be $450. Why? It would be 9 times 100 times 50%. What's my authority for that it's only, the penalty's only on the portion of the fee earned after the transaction? It's 6694-1 F2 2 little i's. I'll repeat. 6694-1 F2 2 little i's. Question B. The CPA takes the basis and depreciation computations provided by Harper and enters them on clause return. Is the CPA tax return preparer with respect to these entries? And can the CPA rely upon them? Is the CPA tax return preparer, guys? And the answer is yes, right? This is just doing his job here, right? It's gonna be considered a tax return preparer. This is just under the general rule of regulation 7701-15B1. I'll repeat, 7701-15B1. Because here, the CPA has primary responsibility for the accuracy of the return. Can the CPA rely on the numbers Harper provides? No?
Yes. Yeah.
If he can realize, then he has to believe that numbers.
He has to do it in good faith, but assuming that the numbers seem reasonable, he can rely, because most clients don't wanna pay people twice to do the same work.
Mm.
So you can, as a CPA, rely on others' work, right? I'll give you a site. This is found in regulation 6694-2E5. I'll repeat. Regulation 6694-2E5. That you can rely on the advice of another. Why? Again, it's a practical matter. Viva, no one's gonna want no one's gonna pay for work to be done twice. Question C. Same facts as above, except that instead of a detailed document, Harper sends Claude an outline of the same issues that took him only 2 billable hours. Now, is he a tax return preparer, guys?
No, less than.
No, he's not, right? He meets the safe harbor because not that 5% threshold, right? Everyone see that? Because now he's got, the numerator would be 2 over 102. And last I checked, that would be less than 5%. Question D. The same facts as A, except that Claude asked Harper for the files instead of the written advice. Harper, as assistant, copy the files and forward them to Claude. Claude then turns over the files to the CPA for his review. Files do not contain a memo or other analysis of the transaction with the conclusion that the requirements of 1031 were met, but rather contain transactional documents reflecting a transaction designed to comply with 1031. On the basis of his review in the files and his assumption that the transaction qualified under 1031, CPA calculates the basis and depreciation figures needed to compute year 1's return, then prepares that part of the return, 12 bill hours. Is the CPA a tax return prepared with respect to the positions reflected in the depreciation deductions on the return? And the answer is yes, right, guys? I know you're tired, but he's clearly, the CPA is doing all the legwork, right? So clearly the CPA here would be considered a tax return preparer. They certainly, this is a substantial part, if not all, of the tax return. Is Harper a tax return preparer, guys?
No.
No, you're not. Planning is not considered preparing a tax return, right? It's only with respect to events that have already transpired. Question E. Same facts as A, above except as A above. Early in year 3, Claude again contracts Harper for basis and depreciation computations needed for year 2's income tax return. Harper sends an outline document with this information. The process of refreshing his memory regarding the transaction and preparing an outline takes him 4 billable hours. Is Claude a tax return preparer with respect to year 2's income tax return? And would the answer be different if Harper took 7 hours? Now remember, it's the same facts as in A. And what are the authors asking or rhetorically asking, do you think? what were the post-transaction hours? Was it 4 or was it 9 plus 4?
9 plus 4.
Okay, now, it could be 9 plus 4, okay? And the authors are saying, suppose it's 7. What the authors are doing here, and there's no clear answer in the regulations, is should you look year to year, like treat each year in isolation, and say, gee, he only worked year 1, he did violate, he is a tax return preparer because he doesn't meet the 5% safe harbor, okay? That's violated, but in year 3, when he's doing this extra work, just look at that year in isolation, and it's only 4 hours, right? And that would be less than 5%. But for your notes, I'm not trying to be ambiguous. It's not clear if you should aggregate or not the hours. Certainly if he works 7 hours, he would cross the 5% threshold, but it's not clear whether or not the hours should be aggregated. All right, not clear whether or not the hours should be aggregated. So you guys, let's just talk a minute about what we've done today. We've looked at the penalties taxpayers are subject to. We've looked at penalties the tax return preparers. For class on Saturday, we're gonna continue and progress and look more at what the duties and responsibilities of tax return preparers are. We're gonna look at these 2 very well-known cases, Loving and the Ridgely decision. I don't know if we'll get there, but if you don't mind, reading up to page, certainly 102. I think we should be able to get to page 102. All right, so that gives you an idea of my expectations for next class. All right, guys? So have a good night, and we'll see you Saturday.